What qualifications do you need to have to be a property forecaster? Well, at a minimum, it seems you need an economics degree and a job with one of the big four banks. But given their track record of getting it wrong way more often than they get it right, it makes me wonder whether they really know what drives property prices up or down in this country. Surely there must be factors that they're not aware of, or perhaps they're just disregarding them. Today, we want to explore the problems with forecasting, specifically when economists forecast without really understanding the dynamics of the property market.
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
Today, we're joined by Louis Christopher, one of Australia's best-known property researchers. Louis established SQM Research in 2006. Before that, he was the head of research and general manager of the property statistics agency, Australian Property Monitors, APM, where he constructed key residential property market indices published by the Reserve Bank of Australia. Now, Louis is widely respected for the quality and accuracy of his market outlooks. And I think we did overlook him actually last year in the Fuller Forecaster report, but don't you worry, we'll get him back in next year's one. And the thing is with Louis, it's been quite a while since we chatted, but he's absolutely a property person, okay? Now, the last time we did discuss things on the podcast with Louis was back in episode 102, which is a bit embarrassing. That's before COVID. So we should not leave it that long again. And what prompted me to reach out to him this time was a post that he made a couple of months back on LinkedIn about FACE by NAB economists about the property market. And I quote, "Disclosure. NAB initially had a housing price forecast of an 11% decline for this year, which was revised to a 4% decline, which was revised to a 2.2% decline, which has now been revised to a 6.9% increase. Looks like they're going to be spot on." Well, we love a bit of sarcasm. Thanks so much for joining us again, Louis. What prompted you to write this post?
Thanks for the nice words, Veronica. Good to be with you once again. And Chris, well, look, as you know, and as you've stated, I've been covering the market for many years now, and what gets under my skin from time to time is you see these forecasts that come out, and look, nobody knows the future, and that's fine, but there's no disclosure that this is a revised forecast. And why did they revise the forecast? It's nothing. It's like as though it's a brand spanking new forecast. Now, some media outlets do put in the note that, hey, this is actually a revision, such as a financial review. But often you will see on sites such as News Limited and other mastheads, they just treat it as though it's a new forecast. And it just gets a bit sickening when you're through the better part of the year and they come out with a forecast, which coincidentally, it's how we're currently tracked.
It's so interesting, Louis. We did the Veronica and I on the last one. It was the banks, wasn't it? Right. And I was the one putting the numbers together. And so I was the one going back and looking at all of their, and some you can get access to. ANZ, they're really hard to get access to, but NAB, I think CBA was really quite easy as well, et cetera, and Westpac. So, but you're right, like every quarter they release them and they completely flip in a dime. And to be honest, they all moved in a very similar sync. So they're almost like, Westpac's changed, and then ANZ would change. And I guess what's frustrating for me as well is similar to you, is that the news outlets just jump on it and not Channel 9 or do a thing on that night, and house prices are going up. And, and a lot of people do unfortunately fall for this, and they just sort of take, so what's your sort of take on, the banks, and, is one better than the other, or are they all just as bad as each other at these, and they all are just making, big forecasts without much behind it?
Yeah, good questions, Chris. Look, certainly over the past 2 years, they seem to be very much in line with each other, both in terms of what the forecast is, then the revision, as well as the timing of the revisions. They all appear to be coming at the same time. It's like as though they get around a round table and try to work it out between each other. It's like, we got it wrong last year. Okay, what let's put in this number. This should do the job. Let's keep in mind too, the banks in particular are one of the country's largest advertisers. So they always get a good run, by our major mastheads. And I think because of that, mind you, I'm a bit of a skeptical person, but I think that's fair comment in my view. But importantly, why do they get it wrong? Now, let's face it, forecasting the future is extraordinarily difficult, and we don't always get it right. So why are the banks not terribly good at forecasting? Well, over the past 12 months, one thing I've noticed with each of the banks is that they've appeared to have completely underestimated the impact upon migration, or the impact of migration upon housing price forecasts. And to me, we could see this coming for some time because it was reported in the budget forecast in terms of the migration numbers. Back in 2021, we were already having a rental crisis, and we were seeing big uplifts in rents at that time, advertised rents. And over and above that, we knew historically that there was a positive relationship between higher inflation and housing prices, particularly if we wind ourselves all the way back to the 1970s, where, for example, in that decade, Sydney house prices quadrupled. And at the same time, inflation at one point was actually up to 17.5%. So there's a strong relationship there. And it appears as though they did not seem to get that relationship.
With the migration, I've often wondered about this because it's a bit of a delayed reaction in terms of property prices or participation in the property market from migrants, right? So they don't all come here and immediately buy. But if we've got a rental shortage, I guess, am I putting words in your mouth by saying, well, if there's already a rental shortage, they're sort of forced to consider buying a lot faster than they perhaps would have been otherwise in a normal type of environment? Would that be fair to say?
I believe so, Veronica. The fact that when we opened up the borders, we were already having rental vacancy rates well under 2%. And so as a new arrival to this country, what do you do? And also let's consider too, many new arrivals have cash to spend. They're coming into country with cash. And the first order of the day is you've got to work out your shelter. And so if the rental market's that tight, the inclination then is to go and buy it if you can, and many have. That's something which I think the banks completely didn't see coming at all.
I think it's also that rental crisis thing is not just for people moving to the country, it's people who are living here, right? There's a real apprehension of renting again. They're getting kicked out of their current place. They can see the rents are going up, that the rental stress is forcing them to buy. Even, just on the phone today with a client, wants to buy an apartment in Sydney for his kids because he knows his kids have got a rental issue. We're convincing him out of it in this situation. But, there is that rental pressure encourages people to buy, even though rates are higher, but also their rents are going up. So I think that's there's not just the banks who have been very bearish. Chris Joy's come out with, 15, 25% declines and hasn't changed his forecasts, to be honest. What else do you think that these people have, because we can't say it's wrong yet because this thing hasn't played out completely, but what other things? I mean, migration's one, but what are the other things that, the psychology behind the market that people are like, oh, rates are going up, house prices should massively fall. Like where are people, because that's what a lot of people have thought.
I think that this goes back to the inflation question. So yes, rates did go up. And in a normal inflationary environment, the magnitude of those increases would have created a correction. And we did have a correction in 2022. But what you've got to look at when it comes to these things is what we call real interest rates. So the actual interest rate after you take into account inflation. And right up through to this year, and right now, we've been running what's called a real negative interest rate. So in other words, the inflation rate's running ahead of the current interest rate. That means that borrowed money is devaluing in real terms. And that creates the incentive for people to go out there and hedge against that higher inflationary environment. And on the ground, we've just spoken about rents. So, those costs going up, and that encourages first-home buyers to get out of the rental market, to buy into the actual real estate market. And it's been encouraging investors as well. I must say, though, recently investors, I think, are getting a little bit spooked by all the talk about rental caps and so forth. But nevertheless, they've been jumping in that market to get that hedge against inflation ultimately.
And so I think that's another great point, right? And, if you've got $1 million of debt today, but inflation's going at, 6-7%, that's not $1 million of debt next year, right?
Well, that's right. I mean, okay, if your average lending rate's been running at, say, in the high fives as a first home buyer, but, at one point in time, we were having inflation running at 8, well, your debt's devaluing.
Assuming there's, enough wage increases within the system, I guess that also matters, right? Like if we're getting wage growth to out of take on mortgages to, because that offsets inflation, right? If your costs are going up, your wages aren't.
Well, Chris, this is a very good question. Everyone does focus on the overall average wage increase, which runs at the moment, it's running just a bit over 3%. What we like to look at here at SQM Research is nominal GDP, so total income coming into the country, which is a representation of not just wages, but small business profits, superannuation increases, the whole box and dice, rents, the whole lot, right? And particularly rents, that's a critical one because we know what's happened to rents. Now, not many people are aware of this, but nominal GDP, so total income's been actually running in the double digits. It's been running at up 13% per annum. And a long time ago, we knew that there was a very strong relationship between, once again, housing prices and nominal GDP, representing total incomes. So when nominal GDP is running at 13%, that's a number not to be sneezed at.
This is so interesting because, people be talking and it's logically, well, costs are going up, inflation's cost of living, the debt's costing more because of interest rates, forgetting the real cost of real interest rates. But, in terms of our hip pockets, we're all hurting, et cetera, et cetera. Fuel's going up, et cetera, et cetera. And so are housing prices, despite the fact we're something like 40% down on borrowing capacity. And how can that be? And I think what you've done is sort of go part way to answering how that can be, is because the people actually buying property aren't necessarily hamstrung by one wage, by earning the normal wage.
That's right. It's a combination of receiving income from elsewhere. So people who have been earning rental income, a rise in small business income, plus the surge in the population. So in the last 12 months, the population has surged by 500,000 people. And now those 500,000 people need about 240,000 dwellings. Where are they going to get it from? The rental market? No, they're buying in the market. And so I think the combination of the two are some of the reasons why we believe our forecasts that we put out November last year are very likely to come in. And when I read the bank's forecasts, each of the majors, they not at any point did they made mention of strong migration numbers or higher inflation impacting upon property prices.
What about, you're the holy grail of listing data, right? Whenever you can look at the core logic numbers, right, which is great, and you can sort of, but, if you want to go in a local area, which is all that matters in property, right, it's all about local markets versus the market. And, if it's one thing, I think it's one thing you can take around property, it's understanding that, it's knowing that what really matters is where you're buying, where you're owning, where you're looking to buy. And your data is amazing, right, with the listing data. How do you think listings have, because that's obviously another thing that the banks wouldn't have really forecast.
They didn't see this. That's right. And in our forecast, we do look at the leading indicators, such as stock on market, auction clearance rates. And very good point, Chris, about the listings. This is the one thing that I don't think too many picked up on in the 2022 downturn, was that we didn't really see any major surge in listings over the course of that year. So in normal downturns, you see a rise in listings, and it's generally a big rise in older stock that's just simply not selling out there, and it's building up. We did get a little bit of a rise, but not the normal rise we get in any standard downturn. It was actually pretty minute. And I noticed at the end of last year, it looked like as though total listings had peaked and was starting to trend down again. And that was a bit of an indicator for me too that, okay, you know what, 2023 could be a stronger year. And yes, so far this year, the truth is that listings have been hovering to about nationwide at any point in time, about 220 to 230,000 listings. And any type of normal downturn you get, you see listings cross over 300,000. So the numbers are well and truly down. And that means, of course, that overall we're not seeing a flood of properties in the marketplace, which would normally create that fall in housing prices.
So there's a combination there. So let's just sort of clarify what we mean by listings here, because I love your chart of particularly when it breaks it down to 30-day chunks. And you can absolutely very, very clearly see those longer, the days on market for those, that sort of dead stock, if you like, that's been building. And in a hot market, people compete for all sorts of garbage with property because FOMO drives everything. But in a slow market, they'll leave that stuff that they wouldn't, that's really not great property. And so when you're looking at total listings numbers, you're looking at sort of what's swelling or what's staying on the market and taking time to sell, as well as what's coming on the market in terms of new listings. And of course, new listings it's only recently started picking up. It's been trending below the 5-year average for some time. So you've got less new stock coming into the market. That pushes buyers into buying some of the older stock as well, because they've got less to choose from. So as demand increases, you start to see that old stock be picked up. Anecdotally, we saw that happening in Sydney. Got back after Christmas holidays and we saw sold stickers on properties that had been sitting on the market. They were a bit stale, and went, oh, okay, this is interesting. That says to me we're having a change, And that's the sort of the nuance, I guess, that we're talking about here when we're talking about listings data, and particularly your listings data shows that very clearly in your charts. So what are you, I'm surprised that the banks don't take that into account, because it's like it seems to be just 101.
Yeah, well, we're going to look at the expertise behind the bank. So you get a lot of chief economists who are putting out these forecasts, and I've been a bit cheeky a long time ago. I used to say chief economists or economists are like the GPs of the medical world. They're good at things generally speaking, but they're not specialists. And I think in this space in housing, there is a lot of factors you really do need to take into account. You need to get down to the micro level from the ground up. You got to do what they call bottom-up research in housing. And I don't think they have time to do it. I think, they're looking at so many different variables, and housing is just one. They're trying to do a forecast on wages. They're trying to do a forecast on GDP. They're trying to do a forecast on unemployment and on interest rates, of course. And then it comes to housing. And I just have this view that I don't know whether they have enough time to really dig into all the factors that do influence housing prices.
Oh, it's such a good point. I mean, I think that I came from a financial advice background into property. You start to see it as an investment and an asset, and the yield and the growth, and the advice. Anyone in the money markets as well, they really struggle around resi. Like, what's it really worth? Like, that's not worth that because of the yield or the growth rate, and it's also because we live in the properties, right? Like, it's a lot of it's driven by the lifestyle benefit of certain assets, and it might not make great investment sense, but people still go and buy it and push prices up because there's a lifestyle need.
It's funny you should say that, Chris, and you're absolutely spot on there. There is that emotional aspect you have with housing that you don't really get with other asset classes. But on the performance metrics, one of the things I don't think people are aware of, especially if you take into account long-term performance of housing, you can look at housing as like the total asset class, and you'll find that housing returns have been coming in at somewhere long-term around 7 to 9% per annum. But what that doesn't take into account is a gearing in housing, which of course can be a double-edged sword. You've got to be careful. But if you look at what we call your return on equity, your return on your deposit that you've made, well, housing kills it. It absolutely kills it. That return on equity number can be often 40 to 50%. It's a very, very strong number. It is because of leverage, of course. When you're geared to say 90% on an asset, and it's running your way, happy days.
It's funny you bring that up. We did a Q&A episode probably about a month or so back, and we tackled a question around how to measure performance of a property, and we were talking about exactly those sorts of things, that you can't really judge it on the total asset value when you purchased it, because you're not actually spending that amount of money. Most of us aren't anyway. We're actually just paying a deposit, and we're then putting usually some cash flow in to support that or to continue making that investment. So the ROI really needs to be on that rather than, the total value of the property when you've purchased. But the other thing that you'd sort of touched on about, bottom-up research, I mean, that says to me that that's really understanding, really local market dynamics and also, in a way, individual behaviour of buyers. And this is the thing that I think that is missed by a lot of property data experts anyway, a lack of recognition that human beings are responding in some way to market forces, to their own desires, their own needs. There's our own behavioural bias. There's all sorts of stuff that goes into the way in which human beings behave in the property market. It's bricks and mortar is one thing, but it's actually not. It's all about human beings. And I think that understanding of how humans respond is what's needed to put some true insight into the numbers. And the numbers are reflecting, the numbers in terms of what has happened is reflecting what human beings have been doing, and then forecasting needs to sort of predict what they're going to do in the future. And I particularly remember back in COVID, and of course we talked to you before COVID, so it wasn't even part of the discussion, but all the banks at that time were coming out, doom and gloom, forecasting sort of 30% price falls and all the rest of it. And I'm thinking, and I'm glad I said it on the podcast, because I was like, actually, when we've all been locked in our houses for, a few months and we're not happy with it, or we want more space and all this sort of stuff, we're going to come out of the gates like greyhounds chasing a rabbit. We are going to be dying to get out there and transact property. And what happened? Exactly that. So that's because I'm thinking, what does a human being do under these circumstances? Whereas I'm presuming the bank economists were looking at, well, if the economy is going to do this, we're going to go in a recession. Well, that's going to have a knock-on effect to prices. Of course, they're coming at it from top down versus bottom up. So I think that that's a really interesting perspective.
Well, I think you're right, Veronica, about that emotional, psychological aspect. And yes, everyone did want us to get out of the gates following COVID, but we've also got to thank the government at the time for just spending a lot of money in saving the economy. And we were concerned, just being upfront with you, that on the outset of COVID, and you may recall there was a collapse in option clearance rates. Its first opening months of COVID, the picture didn't look good. But it was the government throwing money at the economy to keep it going. And I'm still sure without that money, if the government was silly enough not to stimulate the economy, we would have had a very, very dark recession.
I'd forgotten about that.
It would have been very bleak.
So, I mean, the recession, we'll go and talk about your forecasts. I think they're very interesting, which we'll share screen shares. But recession and property, like, what's your sort of take? Like, if a recession, then the governments have to inflate, right? There's jobs, there's people, there's votes that they need to care about, right? So, and that usually relates to, decreases in sort of interest rates, right? To support the economy.
It does, but you got to be careful, because once confidence goes in the economy, it can go for a long time. Now, you good people look like you're about as old as me, maybe just a bit younger. So you'll recall what happened back in 1990.
Yes, I was just thinking about that.
So let's wind ourselves back to the year 1990, where, sure enough, option clearance rates collapsed when we hit a cash rate of 17.5%, and home lending rates are running at nearly 20%. That killed the economy. Now, sure enough, interest rates were cut, but it took a long time for the economy to respond. If you recall, we weren't really out of the recession until about 1993. Okay, so 1991 was a bad year, but they were cutting rates in 91. 1992 was still a bad year. They were cutting rates again. And it wasn't until 93 that, finally the economy responded and confidence picked up. So this is the thing we need to be careful with the economy, that, if you really smash confidence, it can take some time for it to come back.
But what happened to property prices in that time?
Very good question. Depends on the city, of course. Melbourne got smashed. You recall there was a lot of problems, and you may recall building societies going under and so forth. Sydney did better than expected. So in nominal terms, Sydney actually still advanced. In real terms, because inflation was still running pretty hard, it was actually falling backwards a bit. So it was a mixed situation depending on the city, but it wasn't an outright crash, as you rightly point, even though we had unemployment at one point in time at 10%. But I've got to say, Melbourne, a very large city, that city did get hit hard.
So let's bring up your 2023 forecast, if you don't mind. And we can start to, if you are watching on YouTube, you can play along with us, but we'll talk it through as well.
No problem. I'll just
And while Louis setting up, we've never done this before, so good on you, Louis, for being the guinea pig.
Can you see the screen?
It's coming up. It's coming up. The 3 dots. Here we go. Yes.
Okay. So for those who are familiar with our forecasts, people would be aware that we like to put out scenarios. So I'm a housing analyst. I'm not an expert in where interest rates are going to be 12 months from now. I don't know where they're going to be. I know what the market's betting on, but I don't know personally where they're going to be. And I certainly cannot forecast COVID and so forth, right? These things are very difficult to forecast. But what I can do as a housing analyst is say, all right, well, if you tell me interest rates are going to be at this level, I'll tell you what that means for the housing market, assuming inflation is doing this and unemployment is doing that. And so that's how we like to go about it. And one thing I like about this is it means that we don't have to continually put out revisions. We just put out one thing before the year starts and we live and die by this. And if we get it right, we get it right. Happy days. And if we don't, we don't. And we don't always certainly get it right. 2018, we got that year wrong. That was a year where we believed the housing market fell, if you recall. And we believed that the housing market would slow down but not fall. So we clearly got that year wrong. But other years we've generally got it, we've done okay. And for this year, our base case forecast, which we put out in November 2022, is looking pretty good. So the overall forecast was that housing prices would rise 3 to 7%, okay, driven by rises in Sydney. So Sydney would lead the way, followed by Perth. These were the two cities that we believe would drive the recovery for 2023. And I think when we consider the data that we've got, whether it comes from CoreLogic, ourselves, Domain, I think in all three instances, it's showing Sydney is leading the recovery.
Which we now can see in the actual data as well, in terms of the real data. Louis, can you take us through how you put together these forecasts and these scenarios? And I think this is important. We did interview Shane Oliver some years back as well, and he sort of talked about scenarios, but he's also talking about revising. And that seems to be the bank way, that they'll put out one forecast. They're not sharing their scenarios in this way. And if you remember, we did discuss with you, I'm sure you remember this, there was back in 2018, there was that 60 Minutes story that everyone was raving about.
Oh, Lord, I can't
about.
forget the 60 Minutes story.
And Martin North was also featured on that 60 Minute, and both of you submitted various scenarios to them, and of course they latched on to the worst case one, and so that was the doom and gloom.
And they treated that as though that was our base case scenario.
Yeah.
Now, notwithstanding Martin, I like Martin, but he can be a bit of a bear from time to time.
I'm actually going to be on tonight with Martin on his show. He has a reputation of being a bear. He definitely does. So by sharing this, I think this is great because it's much more transparent, right? And what you're doing is, I guess, lifting the lid a little bit to say, well, these are the inputs, and this is the type of, I guess, this is what can happen if those inputs change. So how do you determine what the inputs are? And is it the same inputs all the time?
No. So normally what I do, so we normally release our forecasts in either the last week of November or the first week of December of the current year for the forthcoming year. So when we release our 2024 forecast, they'll be coming out in about 2.5 months from now. And I'm just starting to put the scenarios together as we speak. And what I normally do is that I consider up to 20 different scenarios that housing prices could play out. And then it's a process of elimination until I get to 4 scenarios, which I think are the most likely to play out. So for this year, our 4 scenarios were, first one, what we called rates on hold, which was that the cash rate would not breach 4%. It has just breached 4%, but it looks like we're now on pause. Scenario 2, which was our Goldilocks scenario, which was the cash rate wouldn't breach 4%, and then we'd see rate cuts towards the end of this year. Most likely, I don't think we're going to see rate cuts now. Scenario 3 is our false dawn scenario, where the cash rate was going to go on pause and then potentially start rising again. And it looked like we were getting that, and we still could get that. But based on the recent language from the Reserve Bank, it's looking like a bit of a better bet they'll stay on hold at 4.1%. And then our more bleaker scenario was this sort of like stagflation, recessionary inflation, where we see inflation stay above 7%, interest rates continue to rise well above 4%, you start seeing unemployment rise over 6%. And that was a bit of a bearish scenario where we have this stagflation situation. And fortunately, it doesn't look like that's playing out. So from where we stand right now, it's looking most likely our base case scenario comes in, except that we've got a little bit wrong in terms of that cash rate peaking at 4%. Looks like it's going to peak at 4.1. We were concerned about a month ago about this false dawn scenario playing out. Still watching it in the form of some falls were noted in auction clearance rates of late. But overall, we know housing prices are still rising as we speak. So it's looking like our base case is most likely going to come in, if you forgive me a little for getting the cash rate slightly off.
I mean, going into the sort of 2024, is there any gut feeling of, have you got similar sort of scenarios building in your head? Like if rates stay on hold through 2024, we're thinking this, if rates get cut significantly, or there's talk of rates, or do you think there's going to be another false dawn? What are you thinking?
I'm on a personal mission to help more people make better property decisions. And you can find out all about what I'm working on at veronicamorgan.com.au. And there you'll find resources for first home buyers, details about my buyer's agent mentoring program, access to suburb help for investors, or if you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers.
If you're thinking about buying your first home, upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out via our website, wealthful.com.au.
Don't forget that you can download our free full or forecaster report. Which experts can you trust to get it right? theelephantintheroom.com.au.
Like I said, I'm just starting to put together the scenarios now, and I think there needs to be a scenario there where we consider a rate cut for next year. There is a chance here that the economy could now see very low inflation for 2024. And therefore, we need to consider how the Reserve Bank would respond to that situation. We cannot at this stage rule out a recession as well, though it's looking increasingly likely we're having a soft landing. But we just need to be aware of lags in the data. And I'm well aware, of course, of the precipitous falls we've had in consumer confidence. We're talking about consumer confidence falling to recessionary levels, literally back to 1990 levels, which concerns me. And we know that there can be a lag in the data in terms of retail spend and, of course, GDP and unemployment. We may well still see towards the end of this year further rises in unemployment where we crack at least 4%. That's quite possible. And what would that mean for housing prices in 2024? So there's various things we need to consider. The other factor that's running through my head at the moment is China. So China has a major meltdown like the Asian financial crisis of 1997. That could impact the world economy and impact where interest rates would be, unemployment would be, and therefore housing prices. So there's a lot of factors there that we're just touching on now that will take a fair degree of research before we put out our forecasts out in November. But yeah, they're just some of the things to consider. And of course, you've got the X factors that may well play out. What happens with the Ukraine war? Could that impact upon the economy? Well, you wouldn't rule it out. Of course, part of the reason why we've had a rise in inflation was a surge in food prices. And Ukraine, of course, is a huge grain belt for the world. It's a huge food basin. So if that plays out, I mean, it's been playing out badly, but if it gets worse, that could impact upon food prices and stoke inflation once more.
Louis, is there any sort of other leading? I mean, I can think about obviously credit growth where we are. We can see, when buyer urgency, buyer appetite, changes. People's attitudes towards debt. I guess. I mean, do you look at sort of leading indicators there? Do you sort of? I mean, like the building issues, that played out into the market as well. People didn't have the confidence to go and buy off the plan or do a build. So that meant they had to go into the established market. So that was another factor why I think prices are more resilient. What's some other leading indicators you look at?
Absolutely. Shortage of dwellings is a key factor right now, as well as the ongoing expansion in the population growth rate. We know that, hang on, I just stopped sharing the screen. There we go. We know that it's very likely the population will expand again by some 500,000 people for 2024, unless the federal government puts caps on migration, which that's just a subject they do not wish to talk about. We also know when we look at the building commencements, which are delivered or reported on by the Australian Bureau of Statistics, we're set to build over the next 12 months about 160,000 dwellings. That likely means if those two numbers are correct, we grow by 500,000 people, just like what we did this year, and we only build 160,000 dwellings. That means the rental crisis rolls on and rents keep rising. And how will people respond to that environment? Will they buy a home to get out of the rental market? I'd say they will. That all said, though, if we have a recession where we see a spike in unemployment, people will not have the ability to buy a home.
Well, for the 92 or 94 or 96% of people that are still employed, I guess they potentially can, but the 4 to 8% that are unemployed, they potentially can't. Is there?
They can't. That's right. And the risk is, okay, with those people who cannot, let's say we see a worst case scenario where you get unemployment hit up to 1990 levels, which I think is very unlikely. But let's say you had an unemployment rate of 10%. Do you think in that environment we would see an increase in forced selling activity? I would argue we would. And it's something we actually monitor very closely. And something we haven't talked about today is the fixed rate mortgage resets, which I think many people have actually overestimated the impact upon the housing market and how people are going to deal with mortgage stress. We've noted, and we monitor distress listings activity a lot. There's actually been falls in distress selling activity over the course of 2023, not rises. It's been going the other direction. So this concern about forced selling activity hasn't materialized as yet. I think in an environment where you were to get, say, unemployment of 10%, you would probably see it at that point. But if we are to manage a soft landing and have unemployment hit no more than 5%, then I think we won't see a lot of forced selling activity in the marketplace.
Do you think that 2024 is going to be, I mean, I'm sort of like trying to get myself in the mind of you in November, right? And, if rates stay high, right? And you may I do think there's going to be some debt stress start to build, right? If RBA stays over 4%, people are going to have to, they get their bank holiday for 6 months, they run out of buffers. The bank can't keep kicking the can down the road forever, right? But even if listings increase, do you think there's this I know you said migration's a big demand for housing, which absolutely is, but there's also pent up demand, right? There's the couple that are in the apartment that want a house. There's the first home buyer that's been trying to buy for the last 12 months but can't because they just can't find a good asset. So there's this growing pool of pent up demand that even if we get this increase in listings, which everyone's hoping for, to be honest, there's enough pent up demand with migration and people that just haven't got the right housing or, that suits their needs.
Well, yes, Chris. So, and this is one of the primary reasons, as we've discussed, why the banks got 2023 completely wrong. They completely underestimated the impact upon migration and that underlying demand and that pent-up demand you speak of. But I do believe, too, that there are limits to it. And if you had a recession, a deep recession in this country, do we think we'd see a massive surge in migration? Would the government step in and finally put caps on migration? What would they do in that scenario? Certainly there'd be a lot of pressure upon the federal government to do something about the migration numbers if unemployment's spiking. And what would that mean then for the housing market? So we just need to consider that, look, those darker scenarios, I would suggest, are unlikely at this point in time, but we cannot entirely rule them out because of the rises in the interest rates and the data lag and the big falls in consumer confidence that we have indeed had.
On the consumer confidence, what sort of interests me is that it seems to be in some cases, and I'm trying to remember off the top of my head, but I was listening to the CBA's Economics podcast, and there were times in months, probably towards the end of last year, when interest rates were rising, but consumer confidence wasn't as negative as one would have expected at the time. And I'm just wondering, is consumer confidence sort of following the same patterns that we might have previously seen? Or does our sort of shorter news cycle have more of a reactive influence, or is consumer confidence more reactive and more volatile in recent times? I mean, you've been looking at it for a long time. So is there any change, or is it the same as always?
That's a really good question, Veronica. I would say consumer confidence, remembering the series as I do it, it has become more choppy. I think that's fair. But the major decline we've had now, we haven't had that since 1990. That's what concerns me. So it's reached these new levels we've never seen before over the past 30 years. And consumer confidence is normally the first thing that goes in a downturn. Hence why I'm watching it very carefully. I'm sure the Reserve Bank of Australia is watching it very carefully as well. But I take your point about the 24-hour media cycle, keeping in mind the media always seems to be negative. That's how they make money. It's an interesting one. And certainly we didn't have this cycle back in 1990. Everything's completely changed from then, media-wise and technology-wise.
Do you think that consumer confidence being pretty low now is not a bad thing, though? Do you think that, if we were quite confident, we'd be spending more money, which would obviously be kicking the can down the road, and we'd have more stubborn inflation? So if anything, it's a good sign that we are that, and we can absolutely see it. I mean, CBA produced some data last week that was actually really interesting. It had spending under 30, they're going out still spending money, right? If you haven't got a big mortgage, you're still going out, you're still going cafes, restaurants, nightclubs, etc. You're still traveling. Spending over 50, 60, they're still spending money, but it's the mortgage belt that have really made cutbacks. And, that's our client. And we can absolutely see that. There's a fear around rates, there's cutbacks. But, if consumer confidence does it bounce back? You said it sticks around for a long time, but if we honestly do believe that the inflation genie's back in the bottle, right? And the conversation shifts in 4 or 5 months that RBA isn't going up anymore. The conversation is it going to go down, and when it's going to go down, and will buyers all of a sudden become much more positive and will about the economy because there's a talk of rate cuts, and will that very quickly get factored into prices? Because you don't have to see the rate cuts to say you almost bet on that. You start buying and you're spending knowing that 2024, 2025 these rate cuts are coming on very low listings. And so Can you envisage that world where confidence increases, the likelihood of rate rises almost vanishes, and rate cuts are coming, and buyers then act accordingly?
Yes, consumer confidence could increase again if rate cuts are on the horizon. Let's keep in mind, though, that we've had now some data come out since the pause in the cash rate, and consumer confidence fell again. It fell despite the pause. Why did it fall despite the pause in rates? Could it be that people are getting more and more squeezed and spending's getting cut further and further, and that the existing cash rate is really doing its job? And could it be that, okay, even if you have, say, rate cuts on the horizon, but we're getting a spike in unemployment now, that consumer confidence could fall further based on that spike in unemployment? I don't know about you guys, but I'm increasingly meeting more and more people. This is just very anecdotal, who are doing it very, very tough. Very, very, very tough. Sadly, I know a fellow had a heart attack on the weekend because he was kicked out of his rental home. And he was in a rental home to begin with his wife, because they've been building a new home actually, and that's all gone pear-shaped. The builder's gone bust.
God,
Yeah.
These things are happening. They happen all the time, but I just noticing anecdotally, there seems to be more and more people doing it tough. And I don't know whether that's been playing out in the data yet, besides the big falls in consumer confidence. And that's why we've got to be careful. I'm not prepared to be completely rosy about 2024 yet until we get some more evidence or information that, okay, the economy is having a soft landing. Yes, there's some people doing it tough, but overall, the economy is doing a little bit better than expected. We're hoping that's how it plays out. Probabilities are pretty good as how it's going to play out, but not ruling out this more darker scenario at this point in time.
Yeah, I mean, the cash buffers of clients is absolutely dwindling, right? We can see that. The amount of money they've got in offset accounts and, their net loans.
The Reserve Bank's reported well on that, saying, look, there's actually a lot of buffer there. People have their redraw facilities. We've still got positive savings, and that helps. It's just that, there seems to be a growing number of people doing it particularly tough, which might explain the big falls in consumer confidence.
I think too, interesting that, there's been all this sort of talk about the mortgage cliff, and yet that hasn't played out, as you mentioned, as has been reported. And perhaps that is how it's playing out, that rather than, resulting in forced sales and all that sort of stuff, it's actually playing out in the lack of confidence.
Yes, that's right, because a home is the last thing that ultimately does go in this country. Who wants to sell their home out of distress? Nobody does. No, that's the worst thing. There's a lot of stigma attached to that, right? Nobody wants to do it. The home goes last, but everything else goes first. The holidays go first. The furniture goes first. The nice restaurants go first.
House insurance, health insurance, even.
That's what goes first, but that's what also slows the economy down. That's consumer spending retracing back, isn't it?
Yeah, it's interesting. I think that one of the things stopping people selling, one, if they sell, they can never get back in, right? The reality is they might have lost their whole deposit, paid stamp duty, selling costs, the 150 is now 20 grand, right? But I think that just the support in prices, if there's the people who have got a fair chunk of equity, if they saw prices continue we didn't get that spiraling effect, right? Where if I don't sell now, I could sell it for a lot less next year. Because there was that resilience in prices. I think that's, one of the things that's, because if Sydney prices fell, 15%, which you said in the last, in the 2018 downturn, you could see that happening because you're right, listing numbers were increasing through 2018. That's what I think is really different this like 2022. Listing numbers haven't been increasing, prices haven't been falling, they've actually been going up. That's giving people enough confidence to say, let's just hang on. Let's not list this thing. Even if we are doing it tough, it's worth it because the price of our property is going up. Do you think that's playing out a bit?
I think that's a very fair comment and very accurate comment in terms of the feeling out there at this point in time. Yes, 2018, it was really driven by investors bailing out first. And of course, you remember, it was APRA stepping into the market and restricting lending.
Remember it well.
We haven't had APRA step in this time around. They threatened to do so back in 21, but they didn't do it. They left it to the Reserve Bank to do all the heavy lifting.
Well, they did increase the buffer at the very end of the year.
They did, but you may recall they were doing a whole bunch of other things in 2018.
Absolutely.
A whole bunch of things, which they haven't done this time around.
Yeah, and we also had the Royal Banking Commission back then too. That sort of added insult to injury. But I think what's sort of interesting as well, even just looking at what prices were doing in 2022, yes, they were falling. You see the interest rate cliff that was sort of well publicised going to happen basically in June, July of this year. So there's actually, and interest rates obviously starting to rise from May 2022. So there's like a disconnect in a way between the interest rates rising and actually the big, I guess, impact of a lot of fixed rates expiring. And in that intervening time, prices started rising again. So I guess, that's, if all of that had happened earlier, if the fixed rate cliff had happened, perhaps at the end of 2022, maybe we would have seen a different, I guess, play out there. But I've also got a little bit of a theory. I've got a theory that there's a certain type of human being that is more likely to knee-jerk and panic and have a bit more of a short-term view of things, and more likely to have sold their house in reaction to this scenario. I mean, I speak to that because I think of the people that panicked in the immediate wake of the GFC. This is it, got to get out. And I spoke to people like this. I knew people that did this, and so there's a certain, I guess, subset of the property owning population that is likely to react in such a way, and they'll sort of get out of there quickly, and that sort of part, they're gone. They're not part of the rest of the population. I mean, that's my theory. So I'm wondering does that sort of look like in the data that potentially that may have played out?
I think potentially that is indeed, it may well play out. I'd like to also, with the fixed mortgage resets, just point out that the rise in fixed mortgage resets actually did start from 2022. It's been a very wide distribution curve. And if you look closely at the media at the time, and indeed back in 2021, everyone was actually, not everyone, but a lot of people saying, it's going to peak in 2022. So this horizon of where it peaks seems to be pushed out and pushed out. And that's a bit of a sign that perhaps things are not going to be as bad as what is feared in the media. And I'd also would like to point out to people to read, we speak of banks getting it wrong, but when you read their annual reports and their slides where they look in a lot of detail into their lending book, CBA is a very good one, where they give a lot of information about what's going on with their lending book. You'll see that the bank itself is not really that concerned about it. Look, they're managing it, but then they're basically saying it's been well managed at this point in time. It's not looking like a crisis.
You mentioned the APRA, and it's an interesting conversation if they are going to step in, because there is going to be pressure building on them, right? If rates are on hold for 6 months and inflation's coming back down, should you really be constraining borrowing capacity and getting people assessed on 9% plus interest rates?
Well, you would think, Chris, that the risks are a little bit high now with rising interest rates for APRA to step in and contain the risks in the housing market, right? You'll note that they tend to step in when the market's booming and then take the foot off the gas, off their restricted gas, shall I say, when the market's falling. Where they say, the risks have reduced. Well, actually, I would have thought the risks would be higher when you got falling housing prices, right? Because you got a whole bunch of people falling into negative equity. So, look, I take a view that it's in this current environment, I think it's actually very unlikely APRA will step in because the market's not running too hot, nor is it running too cold. And they would take the view that the RBA has done all the heavy lifting, and we wouldn't want to create further risks of falling housing prices if we were to step in to restrict lending.
I mean the opposite though, to relax lending. So APRA come in and say, let's reduce our assessment buffer from 3% to 2%.
Let's relax lending. Yeah, they could do that. Well, I'm more erring on that side with you then, that they could actually try and ease lending to an extent, have, for example, higher loan-to-value ratios and so forth.
Yeah, and reduce the buffer from 3% back. I mean, it was 2.5. They increased it to 3%, height of 2021, because they had to do something to, get some more first-home buyer votes, really, because they were very upset. But I mean, if they went back to 2% or 2.5%, that's a 10% increase to borrowing capacity. If that's, when rate cuts are happening, I mean, it defies me. I mean, borrowing capacity is fallen by 40%, right? So, but what I think people have done is they've adjusted their budgets, right? So the client who would have bought at $2 million with a $1.6 million loan, for example, now they can probably borrow circa $1 million, right? And what's been surprising, it's been a trickle down effect. So.
You're right. The purchasing power has decreased, but there's more of the client, isn't there? There's more clients out there.
Yeah, and they've still they've still got on with their purchase, right? Because they're going, well, I still have a housing problem I need to solve. I've just changed my solution. And so I think that's been a real big surprise to me, that borrowing capacities have fallen 40%, but house prices have gone up. It just doesn't sound like logical.
No, it doesn't. That's right.
Yeah, and has that been a big surprise to you, just how resilient the market has been? I know your base case was suggesting that, but if you went back maybe 6 months before, like at the mid-2022, are you really surprised with what's happened over the next 18 months? Because, that was when everyone was still predicting very dire forecasts. It's just maybe you are ahead of the curve, what people are kind of catching up to now.
I think I'd say the start of 2021, if you were to tell me that the cash rate was going to hit 4% by 2023, I probably would have been a little bit more bearish at the time. But at that stage, at the beginning of 2021, I wasn't expecting inflation to pick up the way it did. And just keep in mind our earlier conversation surrounding the relationship between inflation and housing prices. And certainly we weren't anticipating the big rise in rents, though the market was starting to get tight. We just were not expecting rents or advertised rents to jump 20% in a year. So yeah, there's this, no, I think on its own, you're right, but we need to consider all these other factors which offset that negative factor. The huge rise in rents, the corresponding rise in migration or overall population numbers, the overall rise in inflation, where people are looking to get that hedge, and a situation where therefore, we've been running negative real rates, which still stimulates the economy.
Yeah.
No, before you get the dumbo, sorry, I just wanted to ask quickly about, because you've got all of your scenarios really show that Sydney and Perth performing stronger than the rest of the country. Do you want to give us a quick insight into why?
Yes. So Sydney's got more to do with the fact that it's the migration itself. So our overseas arrivals, their two first ports of call generally tend to be Sydney and Melbourne. They come to Sydney and Melbourne, and over the next 24 to 36 months, they start to fan out a little bit and move to other regions. But they come to Sydney and Melbourne first. Sydney benefit from that. Over and above that, recall the previous state Liberal government started to move towards reducing stamp duty, replacing it with a land tax. Okay. And actually, the benefit for first-time buyers at the end of last year and the start of this year was quite juicy, right? It essentially could have meant up to a saving of $100,000 of stamp duty if they went down the land tax option. We think that certainly generated interest in the market in particular.
It did. Yes, there's no doubt.
Now, over in Perth, it's really been commodities driven, but over and above that, affordability. So let's just keep in mind that between the years 2007 through to about 2017, Perth housing prices went nowhere. They actually went backwards for a long time. That improved affordability. At the same time, commodity prices have been running pretty strong up until recently, and that always benefits the state economy of Western Australia. That combined with low construction, given the fact that we had low demand for that 10-year period, has meant that we quickly had a rental crisis in Perth, which saw and still continues to see very strong rises in advertised rents. And therefore, as we've seen with the East Coast, basically a move towards buying over renting. Hopefully that explains
it. It does. Thank you very much.
Absolutely. Can you finish it with a property dumbo story you might not remember? Just a little tale, hopefully humorous, that we can learn from the mistake of others. But any property stories recently?
All right, I'm going to give you one that's a little bit different, okay? It's more recent, okay? And it's not to do with residential. Can we speak briefly about commercial?
Absolutely.
All right, sky signage. I have an office here in North Sydney. I don't know if you know North Sydney well, but we're in this building. It used to be called the Bayer Building.
I know the building, yes.
You know the building, right? Okay, so SBS have just now taken out the sky signage rights. It's no longer with Bayer. Guess how much SBS are now paying for this sky signage a year?
Can't even
30?
try.
Mil?
$800,000 a year.
Well, that sounds cheap.
Does sound cheap.
That's not That's not cheap. I think that's the most expensive sky signage in Australia, $800,000 a year. And we're talking about a semi-government body. Where are they getting this money from again? Could that be taxpayers' money?
What is a classic? Is it Chris and I are clearly not experts in sky signage, which is precisely why you should always work with an expert when you're going to buy something as expensive as, or spend $800,000 on something. Consulted with us and we go, yeah, that seems reasonable. Right. So what was Bayer paying?
Well, we know that they were paying that. I can't talk about too many inside secrets, but I know SBS are paying at least that.
I think on that building though, isn't it like a bit of a off to the side? Like
it's on the left-hand side.
It's off to the side. That's right. It's on the other side of the Riga freeway.
There's no competing signs, no competing buildings.
Exactly. Your brain goes to, all these, and there's a lot of developments happening in North Sydney, right?
You get the best views in this building. I'll just flip the camera around. So I get to see the housing market there pretty well.
Yeah. That's your top-down view, not your bottom-up view. But yeah. But Louis, that's a great little Dumbo for us and a great episode, to be honest. I really enjoyed that. I think there's lots of things I hadn't really thought about. The nominal GDP was a really interesting one because
you got to follow nominal. You can get that from the ABS, and if you run that against the CoreLogic's housing price series or the ABS's housing price series, you'll see a strong relationship.
Interesting.
Very interesting. Thanks so much, Louis. We'd love to get you on if you don't mind. Hopefully not 3.5 years' time, but maybe around your next year's forecast. That would be amazing.
I'll try to do that. It's I'm very lucky. SQM Research has grown a lot these days, and I'm a little bit more operational these days. So it's hard for me to do as much media as what I used to. But it's been really good to do this with you guys and your audience today.
Well, we appreciate it.
Louis.
Thank you.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.